Hello everyone. My name is Ratu Beryl Baressa, and my student number is 234-12042. In this video, I will explain about a very useful tool in financial analysis called common size analysis. We will discuss its definition, function, and benefits. This analysis helps both beginners and professionals understand financial statements more clearly and make better decisions. To begin with, let's understand what common size analysis actually is. Common size analysis is a method used to evaluate financial statements by expressing each item as a percentage of a base amount. This method makes it easier to compare financial data across time periods or between different companies, regardless of their size. For example, in a common size income statement, all items are presented as a percentage of total revenue. In a common size balance sheet, all items are expressed as a percentage of total assets. By doing this, we can easily see the proportion of each account to the whole, which helps identify trends or unusual changes. Now let's move on to the function of common size analysis. The main function is to standardize financial statements. This is especially helpful when comparing companies of different sizes or analyzing the performance of one company over several years. For example, if Company A has sales of 10 billion rupiah and Company B has sales of 1 billion, we cannot compare the raw numbers directly. But if we use common size analysis, we can compare the percentages of cost of goods sold, operating expenses, or net income relative to their total sales. This makes the comparison more meaningful. Common size analysis also helps in spotting changes in financial structure. For instance, if a company's cost of goods sold has increased from 60% to 75% of sales over 3 years, that might be a warning sign. Similarly, in a balance sheet, if liabilities are increasing as a percentage of total assets, it could mean the company is becoming more dependent on debt. These insights are very helpful for management, investors, and creditors. Let's now look at the benefits of using common size analysis. First, it helps in identifying trends over time. By converting data into percentages, we can see how certain expenses, revenues, or assets have changed over the years. This helps in making better strategic decisions. Second, it makes it easier to compare companies in the same industry, even if they are not the same size. Since all items are shown in percentages, we can fairly analyze efficiency, cost control, or profitability between competitors. Third, common size analysis can highlight financial problems. For example, if a company's operating expenses are taking up a larger and larger portion of revenue each year, it may be a sign that the company is not managing its costs effectively. This can alert management to take corrective actions before the problem gets worse. Lastly, common size analysis improves financial transparency. By showing every item as a percentage, it becomes easier for non-financial users, like stakeholders or students, to understand the structure of the financial statement. It removes the complexity of large numbers and allows users to focus on proportions and relationships. In conclusion, common size analysis is a simple yet powerful tool in analyzing financial statements. It helps us understand the proportion of each financial item in relation to a base value, making it easier to compare different companies or financial periods. The main functions include standardizing financial data, enabling comparisons, and revealing changes in financial performance. The benefits include easier trend identification, better decision-making, and clearer financial communication. Thank you for watching this explanation. Once again, I am Ratu Beryl Baressa, student number 234-12042. I hope this video helps you understand the concept and usefulness of common size analysis in accounting. Moreover, common size analysis is also useful when presenting financial data to people who are not familiar with accounting. For example, business owners, board members, or potential investors may not understand complex accounting terms, but they can grasp simple percentages. Saying that marketing expenses make up 20% of revenue is much clearer than saying the company spent 200 million rupiah. This simplicity makes financial communication more effective and impactful. In addition, when used alongside other financial analysis tools such as ratio analysis or trend analysis, common size statements provide a stronger and more complete picture of a company's financial health. For instance, if profitability ratios are declining, common size analysis can help identify whether the issue lies in rising expenses, declining revenue, or increasing costs of production. Therefore, it is not only a standalone tool, but also a valuable complement to other methods. To sum up, mastering common size analysis is an important skill for any accounting student or finance professional. It not only helps in understanding financial reports more clearly, but also builds the foundation for more advanced financial evaluation. I encourage you to practice preparing and analyzing common size financial statements so that you can develop a sharper financial mindset and be better prepared for real-world business situations.